Hello Propenomix people, and welcome to the longer form explanation of interest rate swaps. This is day 2 of the December 2023 Propenomix Advent Calendar. So swaps, if you read or listen to any of my other stuff, you'll often hear me talking about the swap rate. So what is it and why is it important, and what is a swap? First of all, well, it's very much the case that the clue is in the name. So what you're effectively doing is swapping one form of income stream for another. So what we commonly see is a floating rate stream, and that might be money that our lenders owe to the Bank of England. So they would be using the Bank of England base rate, but they would be swapping that for a fixed rate stream. Why would they want to do that? Well, because they're going to lend to the likes of you and I on a fixed rate basis. Usually something like a 2-year, a 3-year, a 5-year, which I use all the time and has very strong liquidity, a 7-year or 10-year, or maybe any other kind of notional length of time that you might get a fixed rate loan on. I've seen fixed rates for 20 years plus. And of course, if you go into European countries or the US, you're much more likely to see 25 or 30-year fixed rate loans, i.e. the life of a mortgage, typically. That happens a lot more. In the UK, we've tended to stay towards the shorter end, which in honesty has hurt us a little bit during the pandemic with everything that's happened. But remember, our lender is swapping their floating rate money that they can get. If they're not a big bank, they might not be able to get that from the Bank of England. They may have to get it from another bank. So that bank might give them money at the Bank of England plus a margin, or they might use what's called Sonia. So Sonia, S-O-N-I-A, is the Sterling Overnight Index Average. And this is the metric that replaced LIBOR, which was the London Interbank Offer Rate. You might remember a few years back a bit of a scandal with LIBOR, because LIBOR was one of those metrics whereby the big lenders simply reported what the rate should be. And the problem was the banks reporting themselves often had exposure one way or another to that LIBOR rate. So sometimes it favoured them to declare it just a little bit higher or a little bit lower than it really was. And that was the rate at which they would lend money to each other. That's why it's called the interbank offer rate. But unfortunately, they didn't play the game straight up. There was this big scandal, and of course, effectively they were marking their own homework, and the regulators said, right, no more LIBOR loans, no more loans pegged to LIBOR. Instead, we'll use this Sterling Overnight Index Average. So no one person in each bank or anything is reporting it. It's an average of all the transactions that are proven to be taking place, which of course is much more sensible. So we look at Sonia again over a number of periods. You might well be talking about the 3-month Sonia. That's very typically what a variable rate loan that's on the back of a fixed rate might well default onto. So when you go onto the standard variable rate, that's often what it's called. The lender's standard variable rate, it might be just based on what the lender says. It might be just based on an index like Sonia with a margin added to it. So quite a few loans, if you look into the paperwork at the moment for any of these loans that you might be signing, they might end up at Sonia plus 3.5% or even 4.5% or 5% if you're looking at big margins. And if you were paying that today, you'd be paying nearly 10% interest. So that's a good reason to make sure all your fixed rates are diarised and in your calendars to make sure you don't get stuck on those sorts of rates in the future. Although, of course, in 5 years' time, we'd have expected rates to come down at least a bit by then. So we should be okay. But nonetheless, you're looking at the Sonia rate, and this is available. If you, I Google this quite regularly. Chatham Financial has a pretty good swap rate table. They update about 3 times a day. So one of the important things to understand about swaps is they're not traded on a market like a share price. So it's not something that when the market's open, it's changing every second. There isn't that gigantic volume of transactions necessarily being pumped through the swap markets. They're traded what's called over the counter, which means you need a broker, some kind of broker network in order to make that deal for you. And if you think about it, that makes sense, because what you need in order to make a deal happen, and this is the case for any deal, is you need a willing buyer and a willing seller. So I've explained why banks might want to get money at the Bank of England rate or similar and swap that for a fixed rate exposure, because they're lending to us at a fixed rate. So all they do is they take the risk out of their business model, they add on their margin, which tends to be about 2% over the swap rate, but they'll get that margin, remember, by ultimately using the arrangement fee and the pay rate, which is why you've seen some of these loans with very large arrangement fees recently, so they can get the pay rate down, so they can stay within the interest coverage rules. And ICR, or interest coverage, is something that I'm going to cover in tomorrow's video. So back to, we know why the banks might want to use Sonia and the swap system in order so they can lend money to us, but they need someone on the other side of that transaction. So they use a broker to find that other party. That other party is going to swap fixed for floating, of course. Now they might be happy that, imagine a company that's raised an awful lot of debt, especially when it was cheap back in 2021 or 2022. And now they find that going into 2024, they haven't got many opportunities for this money, but they've borrowed it at a very low interest rate, like maybe 1.5%. And let's say, for the sake of the example, they've got another 5 years left on that bond before they need to pay it back. Well, they might much prefer some exposure to the UK base rate than having their fixed rate of debt for the lenders. So they can ultimately send that money out at 1.5% in the swap transaction, and then they're taking a much bigger margin if they think the base rate is going to stay above 1.5% on average for the majority of those 5 years. And of course, if you ask most people at the moment, they would agree with that. You also see them happen in companies that have got international exposure. So for example, I always think of Disney in these situations because there are Disneylands all over the world, and they might well be looking at a big project in Japan, but there are a number of things to consider because they've got to think about the yen, because what's going on in Japan is going to impact doing works in Japan, of course. So we're starting to introduce the concept of currency as well, and cross-currency. Disney might be able to raise money really easily on the US stock market, but it might not be so easy for them on the Japanese stock market. It could, of course, be the other way round as well. But you can understand, hopefully, why some companies might want to enter into these transactions. But remember, the real relevance to us as investors is ultimately that 5-year Sonia swap rate is going to tell you, with that little bit of margin added on, roughly where the bank rates are going to be. And when they move in a very volatile fashion, you can often see whether it's maybe worth waiting a week or two to see if the rates come down quite quickly, or on the flip side, if they've moved up very quickly, it's well worth getting onto your broker that day and making sure you get a rate secured for a loan in the ideal world. So that's why we consider it so closely, and it's moved from nearly nothing all the way up to 5.25% earlier this year, and it's now down back towards more the 4.25% mark. Remember, that's the cost of debt before the lender's operational costs and margins are applied. So hope that's a helpful video, and as I say, I'll be back tomorrow with a video about the interest coverage rules.